only mode.
Yeah. All right, so we're going to start here pretty soon. We're just opening up the platform to look at some quotes. All right. So this is managing risk using options. I'm Tony Marcucci.
And Keegan.
So this is the risk disclosure. It basically says past performance is not necessarily indicative of future results.
Another way of saying that is whenever you trade, you can lose money. And I've been doing it for over 35 years, and one thing that's consistent year after year is that I lose money. I don't lose money all the time, but that's part of it.
Yeah, exactly. Nobody has a 100% track record. If they do, they're probably lying.
They're definitely lying.
Yeah. So this is Dan Keegan. He started off in the options business in 1978. He worked his way up in the Chicago tradition. He spent 5 years as a runner, phone clerk, and floor broker. He started on the floor in 1984 and was backed by legendary trader Steve Fawcett. And he was also a regular contributor to Futures Magazine.
And Tony Marcucci, he's a young guy, Central Michigan Chippewa. He started his trading career in his dorm room in Central Michigan. So he's really into trading, and he can really help. He's an expert in Elliott Wave, and he's becoming an expert in options. Isn't that right?
We're trying. Yeah, right.
We're trying.
All right, we'll try and speak up for you there, Kevin. All right, so we just want to look at using options to try and protect profits or manage risk, however you want to look at it. And so the first thing that we're going to look at is just going outright short the future, and then we're going to progress into using options to try and trade off of our position. So these aren't any recommendations. We're not saying go short the NASDAQ. We just wanted to have a base case and then trying to expand upon it.
Right. It's, a lot of people think it's something like the NASDAQ has to sell off. Near its inflation-adjusted high. But it's still not. Shorting it over the past year certainly wouldn't work. But at some point it will go down.
Yeah. So we just wanted to look at trying to present an opportunity for us. And so we're just setting the base case of trying to go short the mini NASDAQ from 3670 and using a stop. Now a stop is placed in the market. Generally with that type of stop you would place a good to cancel, meaning that stop's going to be in place until it's either hit or you remove it.
So you're saying short at 3670 and then 30 points up, that's where you want to max out your loss.
Exactly. So, and with the mini NASDAQ, to kind of give you guys an idea too, NASDAQ is about $20 a point, is $20 a point. So on this 30-point, risk or stop that you're putting in the market, you're trying to sell the NASDAQ with looking to risk $600, just to kind of put a nominal amount. And generally for me, that's the type of risk I like to take into a trade.
And you mentioned the good to cancel. Obviously, if you go short overnight and all of a sudden something happens where there's a big gap to the upside, which is usually more of a gap to the downside than to the upside with stocks. But on the unusual case with the gap to the upside, obviously you wouldn't be able to get on it pretty soon.
Yeah, exactly. So say the market, you sell the mini NASDAQ, overnight something crazy happens and the market opens back up at 5 o'clock and the market opens at 37.20. Well, the market never actually touched your stop point. Now, different programs will give you different entries on that. So depending on what market you're using, you might not even be exercised on your stop at all, and you could actually lose more than that 600. We were originally projecting to lose. So that's some of the risk of using outright futures markets or outright stops.
When you pair the stops with the futures, that's one of the one risk obviously is you can get smoked out of your trade.
Yeah.
Like you can just barely touch the 3,700, have a little panic up, and then immediately come back down.
Yeah.
And you're out of the trade. And let's say it keeps going all the way down to 3,600. Well, you missed out on it because your stop order was too tight, I guess.
Yeah, exactly. And
in that case,
to be one who trades futures, to be honest, I have kind of removed myself away from trading with stops strictly because of that fact. I'll put a stop in at 3,700 and the market will trade to 3,701 and then turn back down. So that's some of the risks that you can have in using stops is that sometimes the market will touch it and then go the same direction you thought it would the whole time. So some of you guys are having troubles hearing. Is that the issue here? Or?
can you hear us now? Okay, so now the 3,700, obviously to use the stop, the 2 points that could go wrong is it's touched, you're out of the trade, or it closes and there's a gap up. Now the advantage of using a stop order is there's no premium involved in protecting your trade, which is when we, in other words, when you short a futures contract, you can buy a call, which if the market turns around and runs up, sometimes with Fed announcements that happens, a big move up. If you're long that option, that will run up along with your short futures contract. Okay. So.
Yeah. I think I found the problem. All right, should be better now. Let's go ahead.
Okay. All right, so we're going to take a look at shorting a future in conjunction with a long call.
All right.
Okay. So we're going to go short the NASDAQ at 3670. Okay. And what we can do is we can go long and at the money call in February, which expires in 2 days. That's this Friday, for a total risk of 15 points.
Sorry, we're having some audio issues. That's been a problem. But try to put it in my
Okay. So net unlimited depending on the market settlement, which means that if you're long that call, it expires in 2 days, so you no longer have protection against your short futures contract. But but you can also get out of the trade on Friday. So this is when you don't have to be married to a trade. Okay. Another thing we can do is go long and out of the money March 3680 call, which expires in 35 days. Okay. Now the 3680 call is 10 cents higher than where we're shorting the futures contract. Okay. So if the premium cost is 50 points and it's 10 cents away from where we're short 10, and we're shorting at 10 cents below where the strike price is, that means we have a complete risk of 60 points. We add the difference between where we shorted the futures contract and the strike price and the premium we have to pay for the call option. Now that's a complete, so that's, since these calls we're buying, the 3680 calls are out of the money calls, that premium, the 50-point premium is pure time value. Okay, there's no, the in the money portion would be the expiration or intrinsic value. Okay, so so this way, if this is a very bearish maneuver. Okay, if the market goes up, we're protected by our call, but we really don't make any money. We lose the 60 points that we're limited to losing. But if it does make that big down move, we can cash in that way. Another thing we can do is just buy an outright March 3650 put for 52 points. So. And then if it moves down, if it keeps moving down, and look, if it moves down to 3600, for instance, we could buy a 3600 call. Okay, so that way the 36, if it moves back up to 3650 or 3670, the call will, the put that gain all that profit will start losing it on the way back up. Okay, but if you're long that call, that will cancel that out. Okay, so there's two different things you can do. You can buy the put and just buy the call to lock in the profit in your puts. Now, there's a danger in that, of course. Does anybody today aware of what the danger of that would be if it drops down to that and you buy a call protection against your long put? Can anybody see the danger in that? Okay, the danger in that is okay, Kevin said you have a synthetic position. Yes, you do have a synthetic position, but the danger is you long both a call and a put, and there's a lot of time value in that. Okay, so another thing you could do is you could buy a futures contract against your long put, but that eliminates any further downside profit. Okay, so the long call kind of keeps you in the game, but once again you're paying a price for it. So when you're buying the long call against your short future, you're paying a premium versus the stop order. So the two negative aspects of the stop order are eliminated, but you pay a premium. Same with this. If it plummets all the way down, you could lock in, if you want to stay in the trade, you could lock it in by buying a call. There's a premium to that. Or you could buy a futures contract to whip back up, then it could work. Or you could just flat out get out of the put at that point. So those would be your different options that you'd have, no pun intended, on the options. Two people. So we can multiply. Okay, another thing we can do is using serial contracts in futures, which means you're trading options contracts. Two different options contracts with the same underlying futures contract. Okay. So in March, there's two different option expirations that are based on the same futures contract. So that there's a lot of different things you can do in that. So.
Yeah, so what Dan is saying is that there's two different options that also expire within the same futures contract. So futures are a little bit different than stocks. With stocks, you have one symbol like IBM, and then you have futures based on, with different expiring months. With futures, you have different contracts per month, like NQ, mini NASDAQ. The one we're looking at is March 14, but the next one is June 14. So it would be like under a different futures contract would be associated with those option contracts. So we're looking at the two serials within this March expiration.
So in other words, you can look at the premium levels for the options in the different serials and trade one off against another. And they both flow into the same futures contract. Now there are things you can do spreading the options against different futures contracts. In other words, if you buy a June option and sell a May option based on the June and the May futures contracts, if you're long the June and short the May, to offset the futures risk, you would buy the May and sell the June futures contract for each option contract you did to get rid of the risk for the futures. Okay. Is that clear to everyone? How that works? So even though all the futures contracts are derived from the the underlying crop or index or whatever,
we can kind of show you too.
Yeah, we'll give a.
I can't talk. It's coming from there. So.
Okay. It's just not working.
No, they asked me earlier, do you want to use the current source or do you want the new source? And I hit use current. So I think.
Yep.
Where's the show question? I know I am going to just do this.
Mm-hmm.
All right, so we'll look at mini NASDAQ. Here are the options. So to give you guys an idea, what are we trading? Oh, right here, 36.50. It's hard for me to hear. So here's a current month that we're talking about in February with the NQ. So you can see the price for Feb options and the price for the March options are the same. They're at the same strike. Let's see where that closed. Closed at 36.56. So right around this 36.50 level. So we're not getting bid ask because the market's closed. But what we would look at doing is selling these options to try and capture the March option.
Right. In other words, we go short the Feb and then hoping that decays. In other words, you want it to go right to the strike price of where you're short.
Yeah.
The reason for that is if it goes any lower than that, your short is still going to be worthless, right? But your long will be worth a little bit less than it would have been if it was at. So that's the perfect nexus for that, whether it's a straight time spread where the strike prices are the same, or it could even be different strike prices. But you want that short to go out worthless. That's your goal.
Yeah. So. All right. So looking at gold.
Okay. Now we're going to look at the long straddle and gold. Okay. So we're looking at the Feb options, which expire in 6 days. So we're looking at going long with 1320 straddle. Okay, now gold has kind of been a little bit of a consolidation. So two things happen there. Because of that, the straddle, which is where you're long a call and a put at the same strike price, is not going to be, if this was going crazy, whipping up and down, you wouldn't be able to go long the straddle for as inexpensively as you're able to right now. Okay? So we could go long the straddle 18 points 3 times. Okay? The reason why we do it 3 times because it gives us a little more flexibility. Okay? The most you risk when going long the options is the premium that you bought. Okay? So the worst that can happen with a long option is that it goes out worthless. Okay?
So meaning that the market moves less than 20 or 18 points. So if the market in 6 days can't get to $13 or $13.40, this would be a worthless option.
Yes and no. Actually, if it went between 13.10 and 13.30 a dozen different times between now and expiration, it could work out for you anyways. Now, because most traders out there, when you establish a position, how many of you go into a coma or go into a hammock and forget about it until expiration? You're constantly working it and managing it, right? Okay, same with this. Okay, so I would say 90% of your profits come from adjusting your position when you're trading options. Okay, so now we're going long this 3 times. Okay, that means what we're going to look at is if it moves up or down 10 points, we're going to either go long or short a futures contract. Okay, so if it goes up 10 points, let's go up to 13.30. Are we going to sell a futures contract or buy a futures contract? Anybody have an answer for that one? Okay, the answer is we're going to sell that futures contract. Okay, we're going to sell it, and then in effect, we're going to match that up with one of our long calls. And as we saw earlier, when you match up a long call with a short futures, it kind of acts synthetically as a long put. Okay, so now we're going to be long 4 puts and long 2 calls. Okay, if it went up another 10 points to 13.40, we'd sell maybe another futures contract. So then we'd be long 5 puts in 1 call. And then it drops back down to 13.20. Okay, we buy back our 2 futures contracts, and then it drops to 13.10. We buy a futures contract. So now we're in effect long 4 calls, 3 physical calls, 1 synthetic one, and we're left long 2 futures. So if it keeps swinging between 13.10 and 13.30 or thereabouts, it never has to actually touch 1300 or 13.40 in order for this to be a profitable trade. You just have to be in there swinging, and also the margin is not going to kill you either, because it's not like you're selling naked futures and going long naked futures. You have that hedging technique, which cuts down. It's a great margin buster, put it that way. So.
Yeah, so anything over 18 points you gain from those 3 contracts, that's where you're making your money.
Yeah, let's say in 5 days you're swinging back and forth. You've traded about 25, 30 futures contracts for a profit. You've already reached your break even, and then the next, and it's at 13.20 where it started out at, and it's like, well, but nothing happened. All of a sudden, you find out it gaps up to 13.40 on that expiration day, and guess what? All that hard work you did made you the money. Otherwise, it would have been for like nothing, right? You made it like, oh wow, I made 2 cents profit on the trade. Well, you didn't make. You start out even, and then it goes 3 times 20 cents. That's a nice little profit there for you.
So here's another serial trade, and this is based on the March futures in gold. And let's see. So we're looking at a 13.20 in March versus a 13.35 in April.
Mm-hmm. So that means we're short in the March 13.20.
So we're looking at the 35 in April.
Mm-hmm. And the 1320 in March.
Yeah. And these are both on the call side.
Mm-hmm.
Which is where? So these will be calls. So we'd be looking at trying to sell this 1320 and trying to buy the April 1335. And this is based because this contract expires in 6 days, 5 days now with the close coming into tomorrow. So if the market 6 days from now or 5 days from now settles below 1320, we would still be long our 1335 call.
Right, and if it closes below 1320, like we said in the example before, we'd love it to close right at 1320.
Yeah, 1319 half.
13 or even 1320, because most people wouldn't exercise. Although 1319.5, you're right, because you might get some clown exercise in the 1320. So, but the key is you want what you're short to go out worth. Anything you're long, you want to go to infinity. Anything you're short, you want to go out worthless. But obviously, if it goes to infinity, what you're short is going to go to infinity too. So we're just looking for that short to go out worthless, and our long is going to be worth a lot more than 9 cents then.
Yeah.
If it goes right out at 1320. So, but that's yeah.
So yeah, we'd be looking to buy this time spread, but it's not a true time spread because we're at different strikes. Is that right? Or?
That's correct. It's sometimes referred to as a diagonal spread because you're kind of different strike, different month, you know.
All right, so worst case scenario, say the market sells 1330 in March. You know, what type of downside risk or what type of risk would you be looking at or loss-wise?
Well, 1330 wouldn't necessarily be a loss, actually, depending on what the price. See, on these type of time spreads, it's not like a vertical spread where you can give an exact profit or loss because you're not sure where the pricing of the still long option will be. So let's say it's 1330. The 1320, we would have to buy that back for a penny loss, okay? But we'd still probably make money on the trade because the 1335 would have risen probably higher than 16 points. So even at 1330 would probably still be a winner. We don't know for sure because we don't, you know, that's just based strictly on supply and demand at the moment where the April 1335 would be priced at. But it probably would be a winning trade. So it doesn't have to be right at 1320. That's just the perfect,
Ideal spot.
That's the ideal spot, right? So if it goes much higher, obviously that's not a great. And to the downside, we have our risk defined. So
These are all based off the same serial, like we were talking before. This is based off the March gold contract.
right, so they're both based on the same futures game. So the actual biggest loss for this would be because if it does get if you do get a sign in that, basically you're shorting the future at 1329, okay, and that's 6 points away from the 1335. You add that 6 to the 16 points you paid for this, and you have a net possible loss of 22 points. Because that's, in effect, you'd be entering a long synthetic put position for 22 points to the upside. So it gives you a defined benefit and risk. To the downside, we know what we can lose, but if it tends to just middle around where it's at right now, it'll be a winner.
Okay.
So does anybody have any questions on this one or any of the other ones that we've covered today? Okay, well, Tony and I are both Series 3 brokers, and if you have any questions on anything or you'd be interested in opening an account or at least talking about it, please give us a call at 800-556-9411, or you could shoot me an email at dkeegan@walshtrading.com. It's been a pleasure spending the afternoon with you, and hopefully you can catch some of our future webinars.